Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, John Briggs, Giles Gale, and Theo Chapsalis. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. And also a reminder, I know John kindly reminded you all last week just to send them in for Giles, but you can send them in for any of our Bondcasters. If you have any questions, please send them either directly to us or to our Bondcast mailbox, which is bondcast@natwest.com. Let's get straight into it this week because, it's been a quiet week on the data front and the European side. US side, it's been quite busy. Since we last caught up, we had very strong payroll numbers on Friday, which were kind of strong across the board, strong job gains, but also the fall in unemployment was larger than expected. But now we've just had not quite as strong as expected inflation data this morning. We're literally recording this hot off the press just straight after the inflation print. So I hope you had time to collect your thoughts, John, but how do we kind of weigh those two things up, strength on the employment side, but not quite as strong on the inflation side?
Yeah, thanks, Imogen. And, as listeners know, we recorded the last podcast before the employment report. So this time, at least, we get a full data slate to look at. On the employment report, definitely stronger than expected. I think it was as much of a, continued progress towards the Fed's goal of substantial progress. So as long as we get a good labor market number coming in, next month, we think that the September meeting will be one where they discuss their taper plans and communicate that. So, the number definitely made good progress. It also made progress along a lot of the lines of the social goals that the Fed has espoused along the unemployment rate side. There's a lot of the different demographics, however you look at, the unemployment rate fell greatly. Now we still have a little bit of a participation rate issue. There's still a lot of questions on employment going forward. A lot of that hinges around school reopenings, obviously labor supply. Well, not obviously, but there's a belief, and I adhere to it to some degree, that, lack of daycare that schools have provided have constricted labor supply. So, if we can get the schools open, will that labor supply increase? If we have some derailing because of Delta, that's a real uncertainty. There's also that this number was a July number published in August. So, will the August number show some slowdowns for Delta? These are not like ourselves. We're not particularly concerned about that when it comes to our forecasts, but they're reasonable concerns to have. So, it was a good number. It showed continued progress, but I don't want to, just say that this is all we need. We just need to see, I think, another month here in the employment report beginning of September. On the inflation side, this August is where we had our lull. This data print, again, just looking at it very quickly, looks like used car prices fell more than even we were expecting. We had 0.3, not 0.4 on core, which was 0.4 was consensus. We do still, however, see a pickup in inflation towards year end, with core PCE ending the year at 3.5. So again, we're going to crunch the numbers, but at first glance, this doesn't change the trajectory, especially because one of the reasons why we have inflation picking up more steadily towards the end of the year, as this COVID reopening stuff transfers out, used car prices as a prime example, we have rents and OER picking up. So with that at 0.3 this month, that certainly doesn't seem, again, on the surface, to dissuade us from having this pickup in inflation coming in towards the back end of the year, which is mostly based on the rent side. So the market reaction today is one of relief. You've seen stocks rally and bonds fall back. So there was definitely looks like some fear of this number, but the broader theme of inflation being an issue for the markets and the Fed is going to remain to the end of the year.
I take it then that means that this hasn't really your kind of timeline from the Fed. I know you spoke last week on the pod with Jan about Clarida's comments, and then we've had comments from Bostic as well, which have kind of echoed that sentiment. But this doesn't change your timeline for how we're thinking about a taper and then a rate hike then.
No, and thanks for raising that again, because, I think that Clarida comments, even on reflection, I think are probably even more important than I probably flagged in last week's Bondcast. And not just because the Fed presidents have backed it up. And as a reminder, I do think Clarida is super important. He was one of the designers of flexible average inflation targeting. So him saying that they think that they're going to have much more than what his view of success is on that front. He didn't say that specifically, but that's really what he was getting at. By the end of the year, much more with higher risks with upside risk to inflation is really a strong signal. I mean, I don't think there's any way that he would have had that communication without Powell's approval. But, at the same time, deeper in that speech was also on the labor market side. So both him and Bostic and a couple others here, I think, are telling you that the Fed has either met or is soon going to meet the inflation requirements under flexible average inflation targeting. So the only thing that's left is the employment side. And according to Clarida, he says the end of 2022, that red headline about, rate hikes, whatever, it was more about the fact that he thought the the employment goal will be reached in end of 2022. What is not addressed is a scenario where, I think is going to be tricky for them in the markets later in the year, which is you have 3.5% inflation. You might have that much more. He said above 3% is much more. So you have inflation much more than he has. And you have employment likely heading towards full employment, but you still maybe a year away. Well, what do you do then? How do the markets react then? So that's why I think that you still have to price in higher probabilities of rate hikes into the belly of the curve, because the market is, the distribution of probabilities is going to get wider to the upside. Even if the Fed doesn't go, the market has to handicap the chance that they may have to act in the face of higher inflation. We think it's going to come down, not down to 2, but down to 2.4, 2.5 over 2022. But we don't know that for sure. Our supply chain is going to clear up. Is pricing going to be sticky? It's a very uncertain time. And that uncertainty is all to the upside on inflation and thus on rates. So again, I'm not crazy bearish, but I just feel like the distribution of probabilities means that the market is going to increasingly need to price in more rate hikes throughout the year.
What kind of a range then would you be talking about? You say not crazy bearish, but still looking, I guess, for higher rates from here. We've had a bit of a pause in the rally, through August. We've had a probably 15-bit sell-off in 10-year treasuries, maybe since the beginning of the month. So how much higher would you be looking for them to go over the kind of next few weeks before we get, another round of payrolls data and inflation data in September?
Yeah, it's an important distinction because, like I said, I still think there's some fair questions about this near-term time period. How much is Delta slowing activity? The governments aren't going to impose widespread restrictions. I don't think asking people to wear a mask indoors is a restriction. It's obviously not pleasant for most people, but or having kids go back to schools in masks, they're still going back to schools. Talking about more widespread lockdowns. There's no political appetite for that. But, as Delta increases in the US and we've got a lot of divergences between states, there is a risk that things see a little bit slower activity. My kids are going back to school. I want to make sure they do. So we're just being a little more cautious. We're not eating at restaurants indoors anymore, masked or not. We're eating outside. But, so I think there could be some question about whether activity levels in this Delta period could slow. Like I said, questions about the employment in August. Is that going to reflect things? You've got, there's still, and I do think these are much more valid questions about peak growth in Asia. What's going on with the commodity cycle. The global growth is not looking as unified as it was a year ago because of different vaccination rates. There are reasons to be cautious. So I do think that for now we were in, say, a 110, 130 range in 10-year yields. I think you'll probably be in a 120, 140 range until you get that first round of data in September to clear out the path to the September Fed. After that, again, we still think it's more of a belly-led move. So 5s, 10s, 5s, 30s, flatteners. I think 5s could easily get above 1% as the year moves on, given our inflation forecast. I mean, if you listeners have a different inflation forecast or don't believe inflation is going to be that higher, you're not going to be on board with that. But nothing so far I see derails that. So it is going to be, I think, a near-term range trade without a lot of energy. But as soon as people put their kids on the bus and realize things aren't as bad, maybe you go back to work and sell some bonds.
All right. Well, I look forward to happening then. I guess that brings me nicely over to Europe then, Charles, because I just mentioned, the relatively big sell-off that we've had through the beginning of this month in treasuries, but it seems like European bonds have been outperforming quite strongly. Why is that? What do you think's been driving that move?
Well, I think that it's partly, as I said last week, the memory of what happened just last month, and so it's very difficult for people who have really been through quite a lot of pain to really think about trading the fundamentals again from the bearish side. And I would just echo everything that John has just said about the ongoing uncertainties. So I think that's one part of it, but I also think the ECB is a pretty important part of it. I mean, we were expecting QE to drop to about 20 billion per week on a gross basis, and I mean that would have been more or less in line with last year, which for lack of another benchmark, we've sort of thought that was kind of the path that the ECB was trying to follow. And we now know that it looks like, at least on the basis of the last couple of weeks, that they've been buying quite a lot more than that. We've had two successive weeks of about 27 billion, and at a time when there's really no supply out there. I mean, we had some Germany today, but it really gets very, very quiet in the middle of August. That ongoing pace of whatever it is, it's going to be about 50 billion, I suppose, from the ECB over a 2-week period. That's a pretty substantial support.
And is that the same driver for what's been going on at the kind of 3 to 4 year part of the curve, or is there something else that's been happening closer to the front end that's been driving that?
Yeah, right. So I mean, you can look at the curve, and I guess that the arguments sort of stack up a little bit different according to where you're looking at on the curve. I mean, I'd say that the front end is probably around not that far from fairly priced. I mean, probably I would say that the skew of risks over the coming months that it's that front end expectations are still too low. I mean, clearly we're not going to be talking about rate hikes as a 2022 or probably even 2023 theme in Europe. Certainly not in the next couple of months for 2023, even in an upside scenario. But I mean, now the front end is flattened to an extent where I would say that the skew of risks is probably towards higher rates even in that sector. But what's really interesting is the way, and this is something that I sort of tried to dig into a little bit in our written work last week, that there's a real kind of a curve inversion, as you say, in that 3 to 4 year area. It actually came back a little bit on Friday, and it sort of maintained at the levels that it got to there. But it's a bit of a puzzle, and I quite like to use this. Maybe I should turn this back and anticipate questions that that we may get from you listeners. But anyone who has a strong view, please let that be known. I think it's probably to do with official flows from probably relatively near Europe, in particular I have in mind the kinds of central banks that are forced to a large extent to shadow what the Eurosystem is doing in terms of quantitative easing, and they have quite narrow mandates in terms of what they can buy and what maturities they can buy. And so I would expect that it's probably to do with that, but it's quite eye-catching because it hasn't really been following what the derivatives have been saying. So there's a disconnect there between market sectors, and it's also a level in yield which is got very close to the most extreme of last year, and that is pretty extreme. Okay, so then we can talk a lot about the rest of the curve, but I think that right there, that was a particularly interesting story, and I think there still is.
Okay, we talked then about, central bank flows. We've talked about the ECB. We talk frequently about what foreigners are doing with relation to European rates and what bank treasuries are doing. But we haven't talked at all recently, unless you have, and I've been missing out on those conversations, but we really haven't been talking a lot recently about what pensions and insurance funds have been doing. And I feel like that's something we used to talk about a lot more. Why is it that they just don't seem to be dominating the flow discussion so much anymore?
Well, I mean, essentially, it's because I suppose that the supply and quantitative easing and the foreign flows have all been many orders of magnitude greater than what they've been doing in the last couple of years, at the very least. Insurance and pensions have really just been doing their best to kind of tread water, maintain their holdings. Again, that, and there haven't really been any particularly urgent sort of regulatory stories, which for years were sort of always what people like to follow, because obviously it's a change in behavior which tends to drive markets. So people try to get ahead of those themes. But there is one which is in fact, there are two, I suppose. And actually, there was quite a nice article from the ECB last week in its the economic bulletin, which summarized these quite appealingly. You've got insurance that are really, they've been hurting because of the kinds of long-term contracts that they've written with their clients. And they've been trying to get away from this underwriting of market risk, if you like. I mean, because for such large industries like this, it's very difficult for them to diversify that away. In fact, you might make the case that it's impossible for them. So underwriting market risk, as insurance does, I think has been revealed over the last 20 years not to be a great idea. So what they've been trying to do is basically turn themselves into effectively asset managers and manage funds for you, manage your savings, but not necessarily underwrite things like duration to the same extent. So we've seen a big shift towards unit-linked kinds of policies in insurance. And at the same time, in particular in the Netherlands, there's this ongoing switch towards collective defined contribution. And that doesn't mean that these are industries that won't be buying bonds anymore, but they'll certainly be looking at bonds through a different lens. And I think that perhaps we should be talking about it a little bit more, because in 4 or 5 years' time, when we get past this period where the be all and end all for yield levels and duration is really quantitative easing. Once we get past that, we'll be emerging into a world where the other industries that matter, these ALM industries, are also behaving quite differently. So I think that that's something that we ought to be talking about a little bit more.
Mm-hmm. We ought to be reminding clients of that then. Well, okay, just quickly then, before I move over to Theo, because I'm conscious of time, but I think thanks to John's probing last week even, you are the lucky recipient of this week's question. So I'm not going to restrict you to one word, but maybe just in a few words, you could tell me if European break-evens here are a buy or a sell.
Okay, great. Oh, so pleased that it's me. Well, I think that they're a buy. No, and I have had this long-term target of about 1.85% for the five-year swap in European inflation. I think that the value is probably more in the cash bonds just at the moment, and there are some sort of recent disconnect between US inflation and European inflation, where European inflation has been doing much better. So I can see why people might look sideways at this market and go, is this really making sense? But I think that strategically it's still a buy.
All right, great. Thank you to our listener that sent that question in. All right, Theo, then your turn. Sorry to make you wait so long this week. Now, last week when you guys recorded the pod, it was kind of fresh straight after the Bank of England, and that's the market reaction, was a little bit confusing because they weren't quite sure how to really the new information that came to light with regards to the Bank of England's reaction function that I suppose we weren't necessarily expecting. So now, having had time to kind of markets properly digest that, has pricing across money markets really changed now that the Bank of England, I guess, is telling us that it's ready to implement quantitative tightening?
Sure. I guess what we know is that the BOE will do nothing before we touch 0.5% of the bank rate. We also know that the market prices in that 0.5% to be reached in a little bit less than 2 years' time. So say by March to June 2023. And then we also know that the term structure just moved by a little bit. So we'll compare the SONIA term structure, what it used to price before the meeting and what it does price after the meeting. It's up by around 5 basis points. So there's been a sell-off, but nothing huge. I think what the market needs to really understand is that to the extent that the BOE do stick to the non-reinvestment plan, and this can happen as soon as 2023, we do have significant additional amount of tightening kicking in. So the BOE, they've mentioned that this tightening through the balance sheet, well, first of all, they said that the non-reinvestments are not a tightening. So we start from that. So the BOE, they do not regard that as a form of tightening. So this is one. The other point is that a reduction in the size of the balance sheet during fairly stable conditions should not affect the market. Anyway, what we know is that this was an amount of accommodation that the market did expect to take place, and if things happen as per BOE, it will not be delivered. So the non-delivery of easing is a form of tightening. What we find very interesting is that other than the 2 to 3 year point where things should evolve as pre-meeting, and it is fairly clear that those who are bullish the economy should just be on the paid side with rates. It is very interesting that when we look at things such as, for example, the 5-year sector, this amount of tightening that happens through the non-reinvestment of balance sheet can be, it ranges between 50 to even 100 basis points. So it can be quite substantial depending on the way that the economy will react. Again, it is QE, stock of QE is the contingent, and a reduction, etc., of the stock does not matter, but based on assumptions, it is something significant. Now, is it going to be 50 or is it going to be 100 basis points? Hard to tell, but it is a significant number. It is not like 10 basis points, so it will be something substantial in our view. And this also means that hiking beyond that 0.5% becomes increasingly difficult. So we go to 0.5% fairly easy, but then this exceeding that level becomes difficult, let alone reaching 1%, because from the 1% level, then the Bank of England will consider active selling. And this is why I think the market does not believe in the story of active selling. Before the meeting, the terminal rate was pricing at 70 basis points. After the meeting, if we have a quantitative tightening, in the years to come, then we should price in an even slower grind higher. So we should price in an even lower terminal rate. But what I think is very interesting also is that the BOE, and this has attracted very little attention, is that the BOE, they have confirmed that negative rates are in the toolkit and are operational. Of course, this is not something that is happening now. We get it. We talk about hikes now. We talk about the recovery. Everybody wants to talk about, higher inflation and yields going up, etc. But the important part is that we unlocked the tool of negative rates. And this is something that, it was under consideration. It took 6 months. The BOE did deliver it, but we received a confirmation, which again changes the skew, i.e. from a point onwards, yes, hikes become more difficult, but cuts become fairly more straightforward.
So how are you kind of putting all of this information together then in terms of what you think this means for the shape of the curve? Before the meeting, you had those Series 10 steepeners on. I think you closed those last week. So how are you kind of thinking that this all comes together and what the implications are for the shape of the curve?
Yeah, I think the reason why we closed it is because the messaging is quite different to what we had expected, in the sense of, if you get a clearly bearish signal, then it makes sense to have the steepener. We also felt that steepeners were a trade that did get popularity, and we prefer closing a trade that is very popular before, you know, everybody rushes to close that. So there were, from a risk reward point of view, the risks were high. This is why we closed that. What does all this mean with regards to the bank rate? Well, we think that, and with regards to the curve, we think that tactical guys and the bullish guys will probably keep paying the front of the curve. So this is something where I can envision more selling pressure. I can envision also more selling pressure in longer maturities, the 10-year part. This is a part which we are short, either outright short, or we modified the view into a 5/5 cash for cash short. It's a similar idea. So you know, different ways to express that. But we think that some of the maturities between that 2 and the 10-year bucket will probably struggle to sell off. In which case, you may have a situation where, you know, the very front end and the back end do sell off, but some of the maturities just struggle to sell off because we need to price in a market where there is some inertia, there is some, you know, there is some headwind coming towards further hikes, especially because some of the tightening may actually happen through, you know, through quantitative tightening, through the reduction in the stock of balance sheet.
I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.